let's just dive right in. There's an idea that's kind of hiding in plain sight. And I'm telling you, once you really see it, it changes how you look at pretty much every big decision you have to make. We're going to unpack one of the most misused, most misunderstood words out there, risk. And for me, it all started to click when I began wrestling with this one question. What if the biggest risk we actually face is the way we've been taught to think about risk? What if the real danger isn't some number you can calculate, but it's actually the faulty wiring inside our own heads? You see this conflict of ideas everywhere. On one side, you have the textbook answer. Risk is just volatility. How much things bounce around. It's a nice, clean number. But then you have a legendary investor like Howard Marks who comes along and says, nope, that's not it at all. He says that real risk is something way more visceral. It's the chance of permanent loss, the sickening feeling that your money could go away and never come back. And we're going to dig into that difference because trust me, that's where everything changes. So, to really get what Marx is saying, we first have to tackle the official story. This is the version of risk that you learn about in finance class, the one that's all over the news. It's basically the foundation for so much of how the modern financial world operates. And what really jumped out at me when I was digging into all this is why the world decided on this definition. Volatility, basically how jumpy a price is. It became the definition of risk for one very simple reason. You can measure it. It's quantifiable. You can stick it in a spreadsheet. But, just because something is easy to measure, that doesn't make it the right thing to measure. And once you accept that definition, you get this mantra we hear all the time. If you want a higher return, you have to take on more risk. Simple. It's presented as this neat, mechanical trade-off. But if that was all there was to it, then being a successful investor would just be a matter of turning up a dial, right? There'd be no actual skill involved. And this is where things get really interesting. If you look closely, you start to see the cracks forming in that foundation. This is where that whole official story really starts to come apart. And it's in that gap that we can start to see what real skill actually looks like. This really gets to the heart of the problem. Just ask yourself, if an investor makes a ton of money when the market is booming, but then loses it all when things turn south, is that skill? Or is that just a gambler who got lucky for a little while? This table from Mark's work just lays it all out so clearly. Look, manager A is just the market. Manager B, that's just the market on steroids. Pure leverage, not skill. And C is the opposite, just super cautious. None of them are really adding any value. But then you get to managers D and E, and you realize, whoa, wait a minute, something fundamentally different is happening here. And that is the whole game. The real goal isn't just return, it's what Marx calls asymmetry. It's about creating an unfair advantage in your favor, where you capture a lot of the gains when things go well, but you're protected when things go badly. That's not a formula, that's an art. That's where real skill lives. And this brings us to the first huge breakthrough in this way of thinking. Real risk, the thing that should actually keep you up at night, isn't how bumpy the ride is. It's the chance that the plane actually crashes. It is the probability of a permanent loss of capital, the chance that your money goes away and it never comes back. That is the only definition of risk that matters when the stakes are real. Okay, this next part is maybe the most powerful and honestly the most psychologically twisted piece of this entire puzzle. It's this completely backwards relationship between the price of something and how risky we feel it is. So let's travel back to the early 1970s. There was this famous group of stocks called the Nifty 50. These were the absolute titans of their day. Companies so good, so dominant, that they were considered totally bulletproof. The kind of thing you could just buy and stick in a drawer forever. And the consensus was absolute. People called them one-decision stocks because the only decision you had to make was to buy them. The thinking was, and this was a genuine belief at the time, that there was no price too high to pay for these companies. It felt like the safest, most certain investment you could possibly make. But that feeling was a trap. So what happened? Well, if you bought these can't-lose stocks at their peak and just held on for 5 years, you would have lost nearly 90% of your money. I'm going to say that again, 90%. Gone. The single safest bet on the board led people to absolute financial ruin. How on earth does that happen? It happens because of what might be the single most important lesson in all of investing, and it's right here in this quote. Success doesn't come from just identifying a great company. That's the easy part. It comes from buying it well. The quality of the thing you're buying and the price you pay for it are two completely separate variables. And this just pulls back the curtain on the great paradox of risk in markets. Think about it. As an asset's price goes up and everyone's getting excited, our brain tells us it's safe. It's social proof, right? But in reality, the risk is quietly building with every tick up. And then when the price falls and everyone is panicking, our brain is screaming danger. But in reality, with every dollar it drops, it's actually becoming less risky. Our emotional compass is pointing in the exact opposite direction of the truth. So, okay, if we accept this idea that true risk is this hidden, unmeasurable thing, it kind of leaves us in a tough spot. I mean, what are we supposed to do? If we can't stick a number on it, how do we manage it? How do you make any decisions at all? Well, the answer is to totally shift where we're looking. Marx argues that risk doesn't live in the asset itself. It's not some fixed property. Risk is created and it's destroyed by us, by our own behavior. And he uses these two stories that are just incredible. In one, there's a Dutch town that removes all its traffic signs, and car accidents go down. Why? Because without the signs, people were forced to pay attention and be careful. Then you have avalanche climbers. They get better and better safety gear, but the fatality rate doesn't drop. Why not? Because all that fancy gear makes them feel safe, so they start taking on crazier, riskier climbs. In both cases, the risk wasn't in the system or the equipment. It was in the psychology. And this G.K. Chesterton quote that Marx uses so often, man, it just nails it. The world looks so logical on the surface, like a puzzle you can just figure out. But underneath all of that, there's this wildness, this hidden, unpredictable force. And our tidy little spreadsheets are never, ever going to be able to account for that. So what's the big takeaway here? It's that we have to throw out the idea of predicting the future as some single point on a map. That's a fool's game. The truly intelligent approach is a lot more humble. It's about seeing the future as a distribution, a whole range of possibilities, and then making sure you can survive and maybe even do well, no matter which one of those futures actually shows up. Which brings us to the final piece of the puzzle. This is how we take all of these counterintuitive ideas and turn them into an actual strategy. This is how you don't just survive in a world of uncertainty, but how you actually use it to your advantage. It all boils down to this idea of intelligent risk-bearing. Look, it's not about being reckless, and it's not about hiding under a rock either. It's a three-part discipline. First, and this is absolutely non-negotiable, you have to control for the possibility of total ruin. But second, you can't avoid risk completely, because that just means you're avoiding life and opportunity. So third, you hunt for that beautiful asymmetry we talked about. You put yourself in situations where the upside is way bigger than the downside. Heads you win, tails you don't lose much. I love this Will Rogers quote because it just captures the spirit of this perfectly. You can't get the fruit if you're just hugging the trunk of the tree, right? You have to go out on a limb. The whole art and science of this is figuring out how to get out there without the branch snapping from under you. So let's just leave it with this final thought. The next time you're facing a really critical decision, whether it's with your investments or your life, the most important question isn't what's going to happen. That's just guessing. The better question, the one Marx would want us to ask, is this. What is the full range of things that could happen? And have I prepared for them? Making sure you can survive the worst possible outcomes so that you're still around to enjoy the good ones. At the end of the day, that isn't just risk management. That's wisdom.